All right, so today I wanted to make a video on a stock that I've been waiting to buy for probably 2 to 3 years. This is Constellation Software. Now they do just trade on the TSX as far as I know. So the Americans, I don't even know if you can buy it over the counter, but regardless, I think this is one of the best stocks in the Canadian market, maybe even the best, but one of the best for sure. First things first, if you get value out of the video, please like and subscribe. Check out those links below as usual. So let's get right into it. So if we look at this stock over the last year, it is now at considerably below its 52-week low. I mean, up until very recently, the 52-week low was right around 41.62. We're now down to, as of the day before making the video, 36.60. So it did have a bad earnings report from last quarter. The numbers were definitely down, but I personally believe, again, my personal belief, I think the company is going to be okay. I think that there's a little bit of people that are scared because of AI, potential AI disruptions. But I know the CEO has said that they don't believe that that's going to be an issue. But again, obviously nobody knows. So it's an $82 billion company, so they're very big. They do pay a very small dividend. Free cash flow payout ratio, that's not really relevant. Free cash flow yield of 4% and earnings yield of 1%. So it arguably, some people would look at it and say, hey, it's still a little bit expensive. I don't think that's the case, which I'll get into. So basically what they do is they have a software business, and they basically, the main thing they do though is they acquire other software businesses. So very interesting business model, but I think it's a very good business model because when you look at the really good software businesses, they're very, very profitable, right? They're very profitable, which I think is one of the things that makes them such a good company. So let's check out the numbers here. Like I said, profitability, very, very good here. The gross margin is almost 100%, which is obviously almost perfect. Operating margin just under 16, free cash flow just over 22. Cash conversion is 383, which is phenomenal. Return on invested capital, return on equity are both very strong. So especially return on invested capital, that's a number that's very important because that's basically the return you're getting on capital without having to use debt, which is very important because that means when they put money into something, into an endeavor, they get a very good return on it, right? 23% is a very good number. Financial health, they're good. They're also growing very good still. And not to mention too, their dividend is really the only thing that's keeping their score down here. But honestly, it's not a company that's focused on the dividends. So I'm not concerned about that at all. And another thing that makes me excited here is this is a company that's still projected to grow very well over the next year, 2 years, et cetera, et cetera. If we look at its valuation based on price to sales and based on price to free cash flow, it's about 11 to 12% below that 5-year average. So I certainly think that it's trading at a discount right now. If we check the insider ownership, again, they don't have a ton of insider ownership, but for a company that's an $82 billion company, 2% is actually probably bigger than what the average company of that size is paying out. Another thing that I like is they're not paying any of their employees a crazy high amount of money. There are companies that are literally worth, a tenth of this company that'll be paying their top people like, 3, 4, 5, maybe even $10 million a year. This company, again, the highest paid employee is 2.25 million, which again, a lot of people hear that like that's absolutely insane for what the average person is making. But for an $82 billion company, that's very small. There are companies that are less than 100 billion. There's an endless list of companies that are less than $100 billion that, there's people that are making 10, 20, $30 million a year, maybe even $40 million a year. So, I mean, Starbucks, right? I mean, the CEO of Starbucks, I think makes like 30 million a year. Don't quote me on it. It's roughly the same size as this company. So that's another thing that I like is that a lot of these tech companies, they exist in part or mainly to get the insiders rich. which this clearly is not an example of that. And then not to mention, too, the president of the company is not even getting paid. Now, technically, they might be getting paid through shares, but I don't think they do a lot of stock-based compensation either. So that's not a concern. The average price target for analysts is 55% higher than it currently is. Even the lowest estimate is 45% higher. And that's based on 15 analysts. So that's a pretty good sample size. I think that, 5,600 probably is a little bit overvalued, but I certainly think we're undervalued where we're at right now. Let's check out the numbers here, and then we will go a little bit deeper, and I'll give my estimate on what I think it's worth. So if we look at revenue here, let's go back about, 10 years, give or take. It is a consistent stair-step higher pretty much every single quarter, which obviously we like to see. If we look at earnings, I don't think it's the best way to measure this business, but earnings are down. But again, I don't think it's the best way to measure. When you look at like these tech companies, these software businesses, typically free cash flow is the best way to measure them. Another thing I like is that they have zero share issuance, right? I mean, if you go back 10 years, they had 21.2 million shares outstanding. Almost, 9 3/4 years later, it's 21.19. So they're not only are they very profitable and they're growing very well, they're doing it without having to issue shares, which a lot of companies do not do. So let's check out the metrics here, just because I think that's the most important thing to go off here. Actually, let's check out cash flow first. So we look at free cash flow. Free cash flow is at an all-time high. That is the second quarter ending the second quarter of this year. So we should get third quarter numbers fairly soon. But I mean, free cash flow, 2.38 billion. And if you go back 10 years, it's 366. So that's 7-8x growth over 10 years. If we go back, let's go back 5 years, it's just under $1 billion. So that's, almost 2.5x growth in 5 years, right? So that's phenomenally good growth. And I think that the numbers probably will continue. Let's check out the metrics here, just the one last thing I wanted to get into here. So if we look at their free cash flow margin, the free cash flow margin is basically at its long-term average, right? I mean, it peaked out, that looks like first quarter 2021 at about 31%. But I mean, we're still looking at, 22%. And I mean, if you go back 10 years, it was 21%, give or take. If you go back 5 years, it was 26%. So, I mean, it's basically never went below about 19%, which is still a good number, right? That's still a good number. And I mean, if we look at that number based in the last 10 years or so, the free cash flow margin is actually grown slightly. So this is a company that, like I said, look at that free cash flow growth that I showed there recently, and they've actually grown their profitability number. They've grown their gross margin. They've grown their operating margin. The net margin is the only thing that's actually came down, right? That's the only thing that's came down slightly, but it's still a good number, right? It's still a good number. If we look at, revenue per share, we can look at that. Like I said, consistent stair-step higher. Free cash flow per share probably is the holy grail for a company like this on how you want to measure them. And that's, again, it's at an all-time high, right? It's at an all-time high. And I mean, if you look at them back in look at that last quarter of 2020, they didn't break above that free cash flow number for about 2.5 years. And the share price was still going up significantly over that time. So if we look at their debts, their debt is certainly higher, but their debt as a percentage of their free cash flow, it's not a crazy number, right? It's not a crazy number. So the debt is not a concern either. So let's get into the valuation, because this is kind of the holy grail here of, okay, it's a good company. We've established that. How much is it worth? So let's look at the last 5 years. They've grown free cash flow 17.3%. Earnings, they've grown 8%. The PE's gone up slightly, but like I said, I think free cash flow is the best way to measure this business. They've grown revenue 25%, which for a company this large is very, very impressive. 17.3% free cash flow, also very impressive. But if we look at their average free cash flow over the last 5 years, it's about 28. And like I showed earlier, they're actually trading slightly below 25 right now. So that implies they're definitely trading at a discount. Let's go back a decade just out of curiosity here. Their average price to free cash flow is about 26, so they're still trading below that. And they've grown free cash flow at about 21%. They've grown revenue at about 20%. So the growth is still almost the same, but we're still trading below average. So I think that if we say, let's just be conservative and say a 25 price to free cash flow is a fair number for this company to trade at. Let's go into a DCF calculator, which is basically a calculator of, hey, what do you think the company is worth? How much can it grow in the future? So let's just assume that it's going to grow free cash flow at 15% per year, which is less than the 5-year average. It's less than the 10-year average, actually by quite a bit. They're not going to issue any new shares. The shares are going to stay flat. The dividend's going to stay the same. They're going to trade at 25 free cash flow. That implies fair value is about $4,900, $4,901 to be exact. They're going to grow at 16.62% per year, which is double what the market traditionally grows at roughly. Some people might say, okay, that's still a little bit aggressive. I mean, if we look at, let's go back like 15 years, they've actually grown faster over that time, but the average price to free cash flow is 21.55. So let's just say hypothetically they're going to be traded at 21.55. That still implies fair value is 13. They're still going to grow 13.22% per year. Fair value is 15% below where it's currently at. And I think that those numbers, like I don't see how you could possibly argue that those numbers are overly optimistic. So at the absolute bare minimum, in my opinion, this company is worth $4,200. It's currently trading about 15% below that. So in my opinion, I'm going to set a 2 price alerts. I'm going to set one at 4,200, give or take, and I'm going to set another one at 4,900. Once it goes above 4,900, that's probably when I stop buying or sell. Now, it depends, because if they grow, considerably faster than I'm expecting, the price to free cash flow could still be below average. So it all depends on how fast they grow based on where the fair value is at, because this is projecting in the future. So fair value is projecting where it's at right now, but the compounded annual growth rate is projecting the future. So let's just think of it in what amount of growth is being priced in right now. I mean, let's say that it trades for a 20 price to free cash flow, which is like, 10% below where the 15-year average is. They grow, 12% per year. That's slightly below fair value. Let's say 13% per year. That's basically exactly fair value where we're at right now. A 20 price to free cash flow for a company that's growing at, 19%. Right? I mean, let's assume that they grow at that average 19% and they trade for, let's say a 25 price to free cash flow. That implies they're going to grow 20.66% per year. Fair value is 5,811. That's pretty much what analysts are pricing in right now. So either way you cut it, I think that the stock is undervalued. Now, again, that doesn't mean that it's a guarantee that you're going to make money. Obviously not. But I think if you buy this company and hold it over the long run, I do think it's a good buy right now. So again, that is my analysis. Let me know what you think. And like I said, check out those links below. Hit that like and subscribe, and stay tuned for more.